Hey guys, it's Tash here. We are investing and we are adulting. Come along for the journey. Hey guys, welcome back to my channel, Investing and Adulting with Tash. That's me. I'm an accountant. I like food. I like to talk about finances. I think that's all you need to know. Let's get started. So I received a DM that asked me to talk about investing and like buying shares and all of those things. So I think I'm going to spread it out into quite a few sort of sessions, just talking about shares and investing and passive income and types of shares and all those things. And I want to start off with my favorite from a long-term perspective and something that I do quite a lot, and that's in investing in index funds. So I think a lot of the time investing throws people off just because it sounds complicated. You feel like you don't know what you're talking about, and then you just don't do it, right? I think index funds is one of those things, because you're just like, well, if you've never heard of an index fund, it feels complicated. So I'm going to take us through what exactly an index fund is, how it works, what are the pros and cons, and then at the end of this video, I will also go into some index funds in South Africa, which ones we can access, which ones are South African based. So yeah, stay tuned to the end of the video so that we can chat about South African index funds. So let's start with what an index fund is. Taking it all the way back, the stock market needs to be measured somehow, right? How do you know if your favorite, let's take a restaurant, favorite restaurant stock is doing well or not, right? You could just compare it to the entire stock market, fine. But what asset managers and stuff also do is they take stocks and put them into a bucket, right, based on certain characteristics. It could be the industry. So we could go say, okay, let's take all the restaurant stocks, put them in a bucket based on different measurements, based on how big they are, how small they are, or whatever, and how this bucket performs. We can now say that's how the restaurant industry is performing. So now when I look at my favorite restaurant stock, I can compare it to how the bucket of stocks is performing, and I can say, okay, well, for its industry, it's doing really well, it's above the benchmark, or it's not doing very well, it's below the benchmark. That benchmark is called an index. Now, the whole thing of putting them all in a bucket is really just a mathematical construct. Somebody somewhere with a computer just sort of like adds all the performances together and sees how they're doing. It isn't an actual thing. It's not an actual stock. So you can't actually invest in an index. What? So how do you invest in index funds? Okay, so what someone named Jack Bogle did, he is the founder of Vanguard, and what he did was to say, listen, instead of trying to figure out the right composition of stocks that will hopefully outperform the market or something, why not just create a fund that buys the stocks that are in the index in that same proportion, right? So basically mirror the index. Here's your index, and here is a bunch of stocks that you've bought that are all in that index. And basically, if this one goes up, this one will go up, because it's the same thing, right? This is just a mathematical construct that we put together. Here, I've gone and made that mathematical construct real. I've gone and bought all those stocks in those proportions so that whatever happens here, happens here. So that is essentially an index fund. It's a pool of funds. You go and buy into this fund, and that fund will go and buy the same as what's in the index. And so how the index performs is how your investment will perform. Thank you, Jack Bogle. So if it's that simple, why do you want an index fund? Why did Jack Bogle create it in the first place? Well, essentially, what he's trying to do is get rid of, first of all, the risk of depending on, say, one stock, right? So if we compare, should you buy one stock or should you buy an index? Well, what you're doing is, if you buy one stock, you're really increasing your risk from a concentration perspective. You are just exposed to that stock. What does that mean? You're exposed to how their management performs. You're exposed to whether they have generators, if they have load shedding. You're exposed to their specific results, how they perform. Versus if you buy an index, there's a bunch of different stocks in there, all in the same sort of category, like I said, maybe industry. And if one goes up and one goes down, you're not really feeling that. If the general industry is increasing, your general portfolio will be increasing. Unfortunately, this is equity investing. So if the general industry is decreasing, your general um your general portfolio will also be decreasing. Obviously, there's ups and downs, but typically index funds tend to outperform actively managed portfolios. So now what does actively managed mean? Well, let's first look at an index fund. Remember an index fund, I told you, we've created an index, you just go buy index, well, you buy the stocks in the index in the same proportion, and that's it. That's all they do. And they just sit. And if the index changes, they'll change the fund. So that's called passive management, because you're not actively, or whoever you bought the index fund from is not actively going and deciding, okay, this stock looks great today. These people are coming out with these results. Let me buy this. Let me buy that. No, they're not making any of those decisions. They're just buying what's in the index and then chilling, right? So that's passive management. Active management is what I spoke about. You have to research the stocks, you have to speak to management, decide which stocks you think are good or bad, or who's going to do well, who's making investments, how are they spending their money, what is their capital structure, how good is their management team, all of those things, and then you trade in and out based on that. That's active management. And active management costs more because you have to pay that very qualified asset manager or portfolio manager to actively manage. They need to pay researchers, they have to pay brokerage costs every time they go in and out. So those costs start to add up, versus with an index fund, you basically buy the index and wait. Maybe it changes a bit, and then they'll change it or something like that. So that was also why Jack Bogle wanted to do this. He wanted to make investing more accessible to retail investors. And by reducing the costs, because there's no active management, this makes it more accessible to retail investors. Of course, there's also the diversification. The active managers have to obviously decide how they think the stock is going to perform, but nobody really knows, right? If you just have the whole industry in your bucket, you've diversified yourself away from one thing doing really well and one thing doing really bad. So let's quickly go through what the pros are to investing in an index. So historically, it's been very dependable from a performance perspective. As I said, generally they outperform actively managed funds because you're really just tracking how an industry is doing, right? So they've done really well historically, and so you can sort of depend on that from a long-term perspective. Obviously, if you think about something like coronavirus, right, the pandemic all across the world would have made the whole market go down. And so if you just invested in an index in Jan 2020, in March, you would have seen, oh, it went down, it was horrible, but then it would have come back up again. But over a longer period of time, they generally have been doing very well and outperform actively managed stocks, because they're not trying to predict where things are going or how things are going to do. You're just taking a view on an entire industry or entire set of, companies. I actually saw a very interesting index the other day. There's an index for companies that benefit from the work from home trend. Someone created this index, and so I think it will have things like Zoom and Microsoft and all these companies. TikTok has been doing really well work from home, but I don't think that was it. Like Skype and those kind of companies. So you can buy the index that tracks those companies, and if for some reason work from home becomes completely taboo, then obviously that whole index is going to drop. But generally, you're expecting that index to sort of just keep improving as that trend keeps going year on year. Another benefit that I have discussed is diversification, right? It's called simple diversification because it's not like you're buying a gold stock and then a consumer, like a shopping center, like a FMCG, fast moving consumable goods company, right? Those two are so different that maybe the cycles are different, and so you're diversified. No, you're generally within the same industry, but you're diversified from a company perspective. You're buying lots of different companies as opposed to just buying one in that industry, and so you have that simple diversification. There's obviously a lot of transparency because you know exactly what you've bought. You can go and check what's in the index and you know what you've bought. There isn't anything over and above that will be in there, or anything that will be missing, because it needs to track that index. Lastly, but the best part, is it's lower costs. As I discussed, the fund that you're buying into literally just buys the stocks that are in the index and then they sit right with your money, as opposed to having to hire very qualified individuals who cost a lot of money. There's management fees, there's research fees, there's brokerage fees every time they trade in and out. So what are the cons to investing in an index? Well, first of all, there's no flexibility, right? You don't get to pick and choose what you want. You're buying what's in the index. So that is a little bit of a con. Next con is that you're not going to outperform the market, right? Because you're basically tracking the market. So it's you're not going to do phenomenally well. And there is still the downside, there still equity, so that you can still make losses. Lastly is tracking error, and that is the difference between how the index is performing and what your return is. And you'll find that your return will always be slightly lower. And what's that difference there? Costs. As much as these are lower costs, there are still costs involved, right? You're going to be buying your index from a company that's operating. They have operating costs, they have management costs. It's definitely lower than an actively managed fund, but the costs are still there. So it's not like you're buying directly into the index. There are still some costs that you need to pay. So if after this video you've decided that index investing is something that you want to do, there are three main things that you should consider. First of all, risk, right? From the perspective of what your investment goals are. Are you risk hungry? Are you like super risk averse? Or are you do you have a high risk appetite? Why I'm asking that is because there are different indexes, right? So you can go for a high growth index where they're just investing in these, risky stocks. They have a lot of potential for growth, and you have a lot of risk tolerance. Maybe you're young, but if you don't have a lot of risk tolerance, then you might want to go for an index that's really just tracking maybe a broader market, a really large market, or tracking a market of really well established companies. The next thing you need to consider would be fees. Remember, I said there are still some costs involved in your index investing, and those costs are going to reduce your return. So when you're comparing all the different index funds, and there are lots out there, compare the costs that you're going to be incurring, because that's really going to be the difference if they're all investing in the same index. Lastly is your time horizon. This is so important because index investing really is a long-term play. So you need to make sure that you are in this for the long haul so that you can grasp the best benefits from index investing. So when it comes to South African index funds, so in terms of South African index funds that are based on South African stocks, there's a really cool site. It's called itransact.co.za. I'll put a link in the description box below. And they have the performance results for indexes as at 31 January 2021. Basically, most of the indexes on the JSE. So you can check that out, and that can help inform your decision in terms of which indexes you want to invest in. I think I'll also go through that. You can see that some of the indexes have high returns, some of them low. Let me actually do that right now. Okay, so if I go through this, you'll see we're just going to go through the SA equity ones. So you'll see there's ABSA, there's Ashburton, Core Shares, Satrix, One Invest, and Signia. It's not an ad or anything for anyone, I promise. And you'll see that they have the returns, the 1 year returns over a year. That's how they did over 3 years, over 5 years, and over 10 years. And I think some of these funds are really new, so that's why they aren't like 3, 5, or 10 year returns. But when I spoke about risk appetite, that's so interesting because remember, high risk, high reward, right? But what goes up can also go down just as much. So you'll find with your less risky indices or indexes, they will not really float too much right up and down. But with your high risk ones, you can make a lot of return, but you can also make a lot of losses. So let's see an example. Look at the ABSA New Funds Volatility Managed High Growth Equity. They're telling you this is high growth. And what happened? The last year was coronavirus, the pandemic. They had a negative 20% return, right? Because it's so high growth, it can also crash just as hard. But right above there, you have the managed defensive equity. And it's really showing that it is defensive because in a year that was difficult, it still returned 4.34%. So clearly, it was able to do well. And then moderate is literally in between the two, right? And you can see it was negative 5.83% return. Global equities tended to have performed better than the JSE. So you can see the efficient global equity index did really well last year over 1 year, 25% up. The Satrix 40, which will take the top 40 stocks of the JSE, actually did pretty well, up just about 16%. And that's something you can also do. You know, you're looking at just the top 40, so those are really good, solid companies. Or you could look at the entire JSE. It really just depends on what index you're interested in and what your risk tolerance is. In addition to these, you could also invest in international indices. So there's two ways for you to do this. You could either invest directly into index funds that are international, and you can do this through Easy Equity. So if you open an Easy Equities account and you go to the US dollar page, you can invest in things like Vanguard, which is founded by Jack Bogle. So he has a lot of different indices based on a lot of different companies and industries. But keep in mind that what you're doing there is adding an additional layer of risk, because you have to convert your rands to dollars, then invest. So you're taking forex risk and you're obviously taking the equity risk. Or if you don't want to go through that, there's a lot of South African companies that still track indices overseas. So you can buy, you know, like this efficient global equity, or others that, you know, that would track the S&P 500. I think One Invest has one of those. So then you're not taking the forex risk, you're just using your South African rand to track that index, and you can do that through Easy Equities as well. This is not an Easy Equities ad, promise. So I hope this video helped you, first of all, understand what index funds are and understand the pros and cons around it, and helped you get a better idea of the type of investments that you want to make. If you enjoyed this video, please do like it and subscribe to our channel, because I'm going to keep posting really helpful videos to help you invest and adult with Tash. That's me. I cannot wait to see you on the next video.